G'day guys, Ben from Pumped on Property here. Now in today's video I'm doing something a little bit different. I sent an email out to a few of the people in my list and community in the last month, and I've got absolutely bombarded. I've literally got 200 questions that came back on top of the questions that I'm constantly being asked on our Instagram, Facebook and YouTube channels. So what I've done is I've sort of compiled the questions into categories, and these are 30 of the most commonly asked questions across those 200 questions plus 50 odd a month that we get on top of that. I hope you enjoy this. These are really specific to the current property market conditions, and I hope you enjoy it. So I'm actually chilling out in Simon's office today. He's got the big room in the office. I've got the small room. But he's sort of, as you can see behind me, got the stand-up desk set up. Same as me in my office. He's got the little vision board. It's nice and bright in here. My office is a bit danky compared to his. He's got this sick picture of New York next to me that he hasn't hung up yet, that he got off my brother-in-law for an absolute steal. I think my brother-in-law paid like $400 or $600 for it. My brother bought it off him years later for $50. So good buying, Simon. So the first question's from Andrew Metcalf. Hey Andrew, how are you, bro? Now it says, hi Ben, I'll answer the challenge. Given the tightening in the lending at the moment, what is the minimum you think people need to invest in a worthwhile property, and what would the property look like in terms of type and location? So as everybody knows, I am a quality over quantity guy. I did the quantity stuff in the past and it just didn't work very well, so now I'm all about buying the right stuff. Now for me, after reviewing the Heron Todd White stuff, the KPMG stuff, the BIS Stratnall stuff, I'm really just a Southeast Queensland investor now, and that will be me for at least the next, I believe, 4 to 5 years. So in terms of the market, we're talking Southeast Queensland. The most affordable, high quality product in Southeast Queensland now is Brisbane. Brisbane's actually a lot cheaper than the Gold Coast and Sunshine Coast, despite the population being like double or triple or quadruple the size. But Brisbane hasn't moved in 11 years according to the latest CoreLogic update. So to be buying within that 20 to 24 kilometre ring of the city, which is that sweet spot where you can still get great capital growth, but prices haven't moved yet and the rental returns are insanely good, and you can build those granny flats on them for extra income, you're probably looking at about $380,000 up to about $420,000. Now, obviously there's cheaper stock that I don't look at, like units, properties on main roads, townhouses and stuff like that. What I like to buy personally is the quality houses on the nice big blocks. So to answer your question, Andrew, $380,000 to $420,000 would probably cover it. Now I've got another question here from Ari. He said, what are the capital growth strategy 20 factors to be considered when an individual like myself who wants to get into the market as a first home buyer? Sorry I can't afford to pay your buyer's agency fees, but give me it all. I live in Sydney and I've been looking at houses with medium to large land and have a pre-approval for $600K. Might be considering to buy off the plan in Newcastle, 2-bedroom home close to the beach. Thanks for the question, Ari. I'm not going to list 20 factors because I think everyone else is going to get a little bit bored by that. But what I'm seeing from your question is you don't have a clear strategy in place yet, which means you haven't been able to reduce it down to something very simple, which is one market, Sydney or Newcastle or somewhere else, one region of that area, like the quality pockets of Sydney and Newcastle, and one suburb with one type of property. Here you're talking about buying brand new or building. In Sydney you're talking about doing something else. So I think before you actually go out and do anything, you should take a step back like I do and just take a moment to consider where you want to be long term, what the ideal next investment property needs to be to achieve that longer term outcome. So I can't really answer if Sydney or Newcastle is the right market right now. According to CoreLogic, Sydney and Newcastle are both in the declining phase. After such strong growth, I believe that they're going to continue to decline this year, possibly for part of next year, and then sit flat for quite a period of time after that. So I wouldn't be rushing into the market to buy there. Again, I think in terms of timing, Southeast Queensland, according to the experts, represents a lot more value. Now, I've got Troy Sarro here. Hey, mate, how are you? Good to catch up. Hey, Ben, when is the Mackay market going to pick up so I can sell my house there? Good question, man. So, Mackay, according to Heron Todd White this month, is at the bottom of the market. Mining is starting to kick off in a big way again. From what I'm hearing from my clients that are in the space, construction's picking up again. The discovery phase is kicking off, and there's even some other bits and pieces going on. So Mackay's been absolutely hammered over the last 5 to 7 years, with prices dropping 40% in most areas, at least even 50%. Unfortunately, man, I think it's going to take a full cycle for you to be able to get out of that one scot-free. The decision you have to make, which is a hard decision I had to make in, I think it was 2016 or 15 maybe. I made a mistake like a Mackay, and I just decided to rip the band-aid off because that property was stopping me buying anything else. I took a $39,000 loss on that property, and I just got my borrowing capacity back and made that $40,000 back up on the next one. Lyndall said, "Hey Ben, thanks for the great YouTube content. You give sound advice and deliver some hope while being real." Thank you. I appreciate that. I too have a family with a wife and 3 kids. Just moved over from Auckland last October and looking to buy our first home and then hopefully a second, one step at a time. I like to the strategy with 2 houses and 2 granny flats to set myself up for financial freedom. I did think of buying the first home under 400k, then live in it for 6 months, rent it out and get another one, probably around 300k. Really unsure and don't want to make mistakes you know too well. I'd like to meet and discuss. Have a great evening. So, Lyndall, obviously your position is a little bit the same as Ari's, which is effectively there's no clear plan in place, which makes it super hard to go out there and actually do something effectively. Because without a plan in place, it's really easy to get caught up in this suburb or this market or this hotspot, or to make a mistake around what type of product you buy, which doesn't tick your short-term family box, but also doesn't tick your long-term investment box. So if you want to, mate, happy for you to jump over to www.pumpedonproperty and book in a free strategy session. But it sounds like you're in a great position, and it's great that you're starting to think about this stuff. For $400,000, depending on where you want to live in Australia, that should be more than enough to get a great property that you can build a granny flat on that links you to this longer term financial freedom idea that you have. Peter said, "Hey Ben, I was thinking about doing a subdivision with my sons here in South Australia. What would you advise?" Peter, I just finished a subdivision, which went okay. The advice that I have based on doing it is it's going to cost you more than you expect, and it's going to take about twice as long as you expect. Basically, councils and town planners work on their own timelines. I think they're at like -2 times normal speed or something, those guys. But all jokes aside, price and timelines are the 2 things. The third thing that I learned from doing the subdivision was you 100% make your money when you buy, not when you sell. So take into account the marketplace dropping by 10%, or be 10% more conservative than the comparable sales that you're looking at when you're justifying a site, and really be strategic about what you buy. It actually took me 3 years to find my subdivision site. I was looking for it for that long, but I just could not find anything in Southeast Queensland where I could make the type of margin that made it economically feasible and from my risk perspective work. So I love the concept. I've talked to people that have done subdivisions successfully down there. The margins seem to be quite low. A lot of professional investors probably wouldn't do them because they're looking for at least the 20% net return. But if you're happy to take on the risk and just make those 8 to 12% returns, then you might be able to find something. Again, it's about being really specific, looking at one suburb, talking to all of the agents, showing them what you're looking for, and then getting one of them to go and door knock and find it for you. Alternatively, you can do what I did and letterbox drop, or just build great relationships again with the agents and just wait for them to bring it for you. Hey John, he said, hey Ben, my big question would be, what is the future like for property on the Sunshine Coast over the next 5 years? I was just reading Heron Todd White's report on the Sunshine Coast. It's actually had a pretty strong run over the last 3 or 4 years. So they're saying it's approaching peak of market. Over the next 5 years, I actually believe it's going to be very strong for a few reasons. One, there's a huge amount of infrastructure growth at the moment. There's the Maroochydore CBD, there's the airport, there's the hospital, there's the Aura, as well as the Bly developments, there's the Bock Arena development, there's the Batinia development. You've also got Harmony out there at Sippy Downs. Like, there's so many projects. You've got a light rail project apparently that's projected to start within the next 5 years. You've got Australia's fastest broadband connection being put out from Coolum into the ocean. It'll be literally the fastest point from a networking perspective in Australia, which is going to attract some businesses to it. There's just so many good things going on up here at the moment. On top of that, I was just reading that, what did they say, 30% growth rate into the Sunshine Coast in terms of population over the next 10 years, which is one of the fastest growth rates of any regional area in Australia. I was also looking at the tourism figures for Australia, and the Sunshine Coast was the market in Australia that had the strongest tourism growth last year. So there's also all of the people moving out from Sydney and Melbourne up here at the moment. People like myself, my mum, my brother, my sister. I was talking to one of my mates and ex-clients or current clients from London, Greg, who works, he's a pretty big deal actually over there in London, manages about 350 people for one of the biggest companies in the world, and he's my age. And he said almost all of his mates that he grew up in Sydney have moved up to the Sunshine Coast or Gold Coast in the last 2 years. So, you know, that's happening at the moment. We know Southeast Queensland's growing faster than anywhere. I think it's positive. I've actually been really focusing on this market as an investor. I think 3 out of my last 5 properties were on the Sunshine Coast. I've been targeting really big blocks of land in great locations close to the beach, and we've been helping people buy really high quality long-term stuff up here as well. Rudy has just said, high-end suburbs often hit hard with market downfalls. Suburbs such as Bondi in Sydney and Toorak in Melbourne. Looking forward to your reply. Thanks, Rudy. So yes, the higher or more unaffordable or more expensive, suburbs in Sydney, Melbourne, and all around Australia are the ones that absolutely get smashed in downturns and in markets like we are. So let's say in 2018, the average property price in Sydney dropped by 10%, but the average property in a premium suburb might have dropped by 20% over that same period of time. The asterisk to that is when markets start moving forward again, the more expensive properties go up at an exponentially faster price rate as well when compared to the median product. So that's the risk that you play with that game. Another example of this is in the Noosa in the last GFC, 1 out of every 3 properties in the Gold Coast were being sold by the banks as mortgagee in possessions. That's how bad it got up there in the last GFC. When people say Australia didn't get smashed, they're just talking about Sydney and parts of Melbourne. But Noosa got hammered. There were properties that were selling a year before for $3 million, selling for literally right on the water at Noosa for 500 to 700 grand. Those same properties are now selling for $4 to $5 million. So if you've got the stomach for it, more expensive properties in premium areas often perform very well long term. But you've just got to realise like the ups and downs. Now, in the suburb that I live on in the Sunshine Coast, which is beautiful, if I look at the magazines or the online, it says that the suburbs lost 30% of the value this year. But that's because last year there were all of these beautiful waterfront homes. It's a small suburb with only a small number of sales, which means the averages get affected. And that's why I don't look at averages, I look at sales history. But, you know, a bunch of these beautiful waterfront homes obviously sold because it was the top of a market and it was the most expensive these homes had been since 2007. So people were finally getting out of them if they paid a lot for them back in the day. I was buying there last year, so I was buying at the top. But, you know, they're saying that the market's come down by 30% there. The reality is, when I look at the sales history, nothing's changed. Those expensive sales just aren't there this year. Jason said, hey Ben, at the moment, what is going through my head is not if, but where to invest. I feel the same way, mate. More specifically, it's now-ish the time to look for opportunities in Sydney and Melbourne. I suspect you'll still have the same preference for Southeast Queensland, which I don't agree with, and think there's plenty of potential there also. But my thoughts are, if I only buy a couple more properties, should I wait a bit longer till Sydney and Melbourne bottom out and then I can hold there long term? Akin to the old saying, be greedy when others are fearful and fearful when others are greedy. P.S. Loving the podcast and YouTube vids, especially how you sneak into podcasts on the way to work. It's called laziness, mate. I just like to use that time to be productive. When I'm not concentrating as much, I think my content's better. So Jace, really good question. I'm getting this one all the time from people that live in Sydney and Melbourne at the moment. Now, no, it's not the right time to buy there in 2019 because you might think that it is bottoming out, but I'm telling you, man, it's going to drop by another 10% in Sydney this year and probably another 5 to 8% in Melbourne this year, based on what I'm looking down the barrel of. Now, the asterisk again to that one is if APRA begins to soften and the banks begin to allow money to start flowing through the economy again in this first quarter of this year before the end of March, then the destruction in Sydney might only be 4 or 5% this year, and in Melbourne it might only be 3%. But I don't know if that's going to happen at this moment. That's crystal ball thinking. It's certainly not at the bottom. And what you've got to remember based on the history is not only is Sydney and Melbourne getting hammered at the moment from a price perspective short term, which is fine, it happens. Between 1988 and 1990, property values in Sydney dropped by, 25% in 18 months. Obviously people that, thought that the world was going to end then didn't know that over the next 30 years it was going to go up by 300% or whatever it's done. So, just remember this is a long-term game, which you are. But it's important also to remember that we're nowhere close to the bottom, and what generally happens after a major correction, which is what Sydney and Melbourne are going through now, and they should be, is property prices don't immediately rebound. It takes years for the market to be cleared and to get its confidence back down there. And it can take years because if property prices do drop by 20% in Sydney, they're still expensive compared to the average person's wage. And so it could, be a period of flatness for another 2-3 years after that. That's, again, crystal ball thinking, but I just don't expect the 5-year, even 10-year returns in Sydney and Melbourne to be excellent right now, or anywhere close to comparable what you can get in Southeast Queensland over that time. Saying that, though, once Southeast Queensland goes through its run, again, it's going to sit flat after that, obviously, or potentially decline a bit at the top, and then Sydney and Melbourne will be the market to get into. So I'm personally waiting until the next global financial crisis to buy in Sydney and Melbourne, but, everyone's on a different time frame and has a different strategy. Alex has said, hey Simon and Ben, I thought of a great topic for a video that I haven't seen covered elsewhere. In today's gloom and doom market, with a downturn in big cities, it could be trendy. It's all about what the banks can take away from you. Not that you've been a bad debtor, which means everything, but when you've been a good one and haven't defaulted. So I'm not going to go into this because there's a bunch of stuff here, but he's basically said, under what conditions can banks recall a loan or recharge lender's mortgage? So what effectively Alex is saying here is, let's say that you bought a property in Sydney in 2017 for $1 million and you put a 20% deposit down, which means you owe the bank $800K. But between 2017 at the top and 2020 at the bottom, at the start of 2020, for example, that property is now worth $900K, or worst case scenario, $800,000. All of a sudden, your loan to value ratio on your property is at 100%, which no bank in Australia wants, and no investor likes either, because it means that you can't do anything again until the property increases in value, and it's difficult to sell out of it because you might sell at a loss. I don't know too much about how banks call on people in those positions. I've heard from talking to my mortgage brokers in response to this question that as long as you're making your repayments, it's highly unlikely that they're going to call on you immediately. But if the bank's balance position gets really bad, there's a chance that they could call on you. And history in Europe, America, and even Australia has shown that that has potentially happened in the past. So it's a great question. It's not something that I'm particularly wary of myself, just because if you can continue to make the repayments on the loan, the likelihood of you not being able to create a solution with the bank, because remember, the banks are people as well, they want to continue to get their passive income from you, from the money they lent you. So they are actually quite reasonable when you're in really bad financial hardship to negotiate something with you. But again, never say never. Like, if their balance sheets look just as bad as, you know, the investor that they're calling on sheets, they're going to choose their survival over the investors. Joan said, what is the best rate for renovations? We own a house and want to knock it down and rebuild. So, great question. It really depends. You know, your question is really not about renovating, but actually knocking down and rebuilding. So when you're building a brand new home, the things that affect price is the size of the home, if it's single story, double story, the builder that you choose, the market that you're building in, the time of the year and how desperate the builder is to actually get the work, and how much you pimp out the home with the inclusions and fittings and fixtures. So I've built homes in southeast Queensland for $1,000 per metre squared that are just single story standard investment style products. I've also seen the same homes in Sydney or Melbourne being priced at $1,500 per square metre because the price of trades down there is so much higher. I've also paid over $2,000 a square metre for a really beautiful double story home. So again, it really comes down to what it is that you're working towards. If you are doing this in southeast Queensland, more than happy to introduce you to the builders that I've worked with. I've built 6 homes, I think, in the last 5 years. So there's some people that will definitely look after you from a price and a quality perspective I can introduce you to if that's something that you need. Costa, how you doing, bro? Hey Ben, I know you respond to every email, as I've probably emailed you more than a few times. My situation's changed. My wife no longer works. Happening all the time. People having babies, people lose jobs, people get jobs. And I get X amount of dollars a week from my job. I currently owe a very small amount on your home, well done bro, and have no other debts. We have 2 girls, 7 and 9. Our home is valued at $700K. My broker says I've got no chance to get into the property market, but how is everyone else doing it? I've seen some cheap houses down the south coast of Illawarra, but every time he asks me, he says I have no chance. So I've also tried to bring my brother into investing with me, but I don't think it's a good idea. So effectively, Costa, I think it's a really bad idea to invest with your brother, because you might be able to get the money, but it's going to stop both of you moving forward in the future. Now, the reason for that is because when you borrow money with someone else, the bank holds you both 100% liable. So let's say that you go and borrow $500,000 and you buy a $600,000 home and it rents for $500 a week. So the bank holds you both fully liable for that full $500,000, both you and your brother-in-law, because you're both signatories. The bank then only takes into account 80% of the rent, so you're only looking at $400 a week of rent for future servicing, but then they divide it by the 2 of you. So effectively, from the bank's perspective, if you buy with him, you're both liable for the full $500,000 of debt, but you're only receiving $200 a week of rent, which is a really negatively geared on property on paper, which the banks hate, and that's going to stop you and him moving forward again. Now, the thing that's holding you back, man, is your income and your dependence and the fact that your wife's not working. Because from the bank's perspective, you've got debt, you've got kids in school, and you've got a wife who's not working. The only way for you to get around this is to either increase your income or work a second job or start a little business on the side and make more money, or to get your wife back into the workforce part-time. I think because your position is so strong, you actually will be able to borrow money to buy a property if your wife does go back to work. So she might not have to go back full-time, but part-time could really help with your position. Pratap said, how to buy distressed properties in Melbourne in the current market. Now, like I said, it might feel cheap right now, but it's going to feel a lot cheaper in 12 to 18 months from today, I believe, based on the people that I've been following. So I would be waiting to buy a distressed property. But obviously, there's a few people this year whose rates have just gone from interest only to principal and interest. There's a few people that are spooked by the current market and therefore will be selling. There's also a lot less demand in Sydney and Melbourne right now than there were 2 years ago. So from a buying perspective, it is a marketplace where you could take advantage of it. Not every property on realestate.com is what I would call distressed right now, but there might be someone who, if the Melbourne market in that suburbs dropped by 10%, might be willing to sell 20% below the peak to someone who's in a good position just to get the property off their hands. So in terms of how to buy them, you can look at the Public Trustees website. You can buy property directly off the Victorian government through the Housing Commission, ex-Housing Commission homes. You can talk to local agents and let them know that you're looking for a distressed sale. If something comes up, please get them to let you know. You might even be able to spark up a relationship with a solicitor who specialises, as bad as it sounds, in deaths, divorces, or deceased estates, and you might be able to get them to alert you of auctions that are coming up where people are being forced to sell because of, unfortunate circumstances. Not really that time of the cycle where you're going to get absolute deals. You've got to wait for the next global financial crisis or full-on depression, but there are opportunities around that there weren't a few years ago. Rory, great to catch up, man. How are ya? Can't wait to go to Bali with you later in the year, man. Until when is safe to be buying based on Phil Anderson's prediction of a downturn in 2026 onwards? So when is it safe to buy after 2026, which is Phil Anderson and Fred Harrison's predictions for the next major financial crisis? Is it still worth looking at purchasing an investment at the moment when it's looking like we're going into a bit of a recession right now and house prices are falling? Cool. So 2 questions. One is, when we go through a global financial crisis, when is the time to start looking at housing? Because it takes a while for the housing to fully bottom out and the pain to get all the way through from the business market to the stock market and then into the property market. So from what I've seen based on reading Fred's book, which looks at 350 years of booms and busts in Europe, and then Phil's book looks at 250 years of booms and busts in America. Fred's book looks at Europe over 350 years. Effectively, you've almost got to wait 18 months to 2 years after the major downturn starts to really be buying at the absolute bottom. Obviously, all the way through that period, there is distressed assets being sold, but 18 months to 2 years into a recession or depression in a really bad environment like a GFC is when almost everyone else can't borrow anymore, has lost their paper wealth, and has been wiped out in stocks, shares, super, properties have gone down in value, and that is the time when you want to be coming into the market with cash and cash flow to be able to be buying those distressed assets. Now, I know clients that have bought America for literally 30% in the dollar. I know people that bought Noosa, Sydney, Melbourne in the last GFC, parts of Brisbane for 30, 40, 50 cents in the dollar of what they should have been worth. And obviously they've got whatever growth has come after that as well. So, that's timing there. Still worth looking at purchasing investment property with it looking like we're going into a bit of a recession now. So the period we're going into, I believe, is the best opportunity that you and I have had to buy since the last GFC. For a while, I was sort of, approaching it with a bit of caution, but now I'm beginning to realize that it is that time that Warren Buffett describes as beginning to become a little bit greedy when others are being fearful, because there's a lot of Australians right now sitting on the sidelines and being fearful when others are greedy, which was kind of like the last few years that we've been through. So I actually believe the next 18 to 24 months, or even 6 to 24 months, represent incredible buying opportunities in the right markets to set yourself up for the second half of the cycle before we get to the top. Now, history has very, very consistently, according to Fred and Phil, repeated itself, but for some reason we don't learn from it. And there's no guarantee, none of us have a crystal ball to look at the future, and that's very, very dangerous to think that you can. But right now we're going through an environment where a lot of people are sitting on the sidelines. It's a bit harder to get money. We may go through a bit of a technical recession in America and Australia over the next 6 months to a couple of years. And for smart people, that'll be a good time to time your buying of certain assets like shares, stocks, property, whatever else is your flavour. Hey Mark, how you doing, mate? What's your view on the potential impact to the property market if Labor wins the election and delivers on their promise to remove negative gearing and the implications for capital gains tax as well? Really good question, Mark. Definitely something that's been on a lot of investors' minds in Australia over the last year, or 2 years actually. So Labor has come out literally in the last couple of weeks and said that they are not going to talk about negative gearing until after the election is over. Now, I think about it this way, and this is ripped off from John Gant's thoughts around this sort of stuff, is that the conversation around negative gearing and capital gains tax was initiated when everybody in 2016 and 17 in Sydney and Melbourne were complaining that their property prices were too high. And it was topical from a political perspective to begin a conversation around, something that's going to help with affordability. But what happened at the same time is APRA stepped in and went, boom, let's make it super hard for investors, which are causing the problem in Sydney and Melbourne to borrow money. And it has had this huge slowing effect on the Australian property market, but mainly the Sydney, Melbourne and Darwin markets. So all of those markets have now been declining for over a year. Darwin's been declining for a lot longer than that, so has Perth. But what I've read into, what my thoughts are, is it was a topical conversation which was hopefully going to have the exact same impact that what APRA has stepped in and done, which is slow the market down. And so, it would be very, very unpopular if the property market, by the time Labor's in and beginning to talk about this stuff again, has already dropped in Sydney by 15 and 10% in Melbourne, to come in with something like that, and especially when the Liberal government's just about to put us into a surplus budget again, where we've got actually more money which can be reallocated into other things like affordable housing and infrastructure to get things going again. So it's just important to recognise that around, it was a conversation that was very politically hot, but now it's not politically hot, and Labor has just literally iced it. And I think it would be disgusting politics if they don't, if that is something huge that they bring in after an election without discussing it openly and debating it in a public forum before the election, so that people can make the decision as to who they're voting for. I'm not left or right, I don't care about politics, but because I'm an investor and a business person, and because of the stage of the cycle we're in, I'm personally going to be voting Liberal, because I want a government that understands money management, that can take that surplus budget and reinvest it to get things cranking again for the second half of the cycle. Now that's, like a greedy thing, I suppose, or it's a selfish thing for me to want that, because I understand that sometimes that money doesn't always flow into some of the things that other people need, like my sisters in education. A lot of my friends are nurses and doctors in healthcare. A lot of friends are studying, and, those people unfortunately don't always get looked after as well with the Liberal government. But I'm a speculator, I'm a property investor, I'm a business person, and I want the economy to keep moving with some stability so that I can continue to set up my future and my family's. Steve said, hey Ben, cheers for the email. Where should I target city for a first investment property that will blossom? I love those words, bro. Blossom. In the next 10 years. Good capital growth, not too negatively geared. I'm not sure if I'm too late to benefit from Brisbane or I should look elsewhere. So in terms of the capital city that I believe that's got, or capital cities that I believe at this stage of the cycle have really good potential for the next 10 years. Obviously Brisbane and, potentially Gold Coast, Sunshine Coast. Perth looks like it could come good again within a couple of years from today. I'm not a huge fan, as everyone knows, about Adelaide or Canberra. I think Hobart's had just as much growth now as Sydney and Melbourne had. I think Hobart, has hit its capacity or will do very soon. And then we all know that once we hit top, we slide backwards because there's been a lot of speculation there in the last 2 years. It hasn't been owner-occupiers driving that growth or sea changes. It's been complete speculation for probably 3 years, like Sydney and Melbourne. So Sydney and Melbourne's done for now. For me, I really like Brisbane, man. That's where I'm putting my money. Or Sunshine Coast. I think Gold Coast has had a pretty good run and is it probably at a stage where it's very well priced in for the current market. Fiad said, hey Ben, hope you're having a great day. How does some real estate investors buy one property per year? We just bought a principal place of residence 6 months ago, and to my judgment, we bought it 3 to 5% under market value. Great stuff, man. Buy under market value, why not? We are wanting to jump into our next property and grow as aggressively as we can. So there's two things that enable investors to move forward faster. Now, this isn't what I've learned from buying $350 million worth of property for clients. This is what I've learned from buying 12 properties myself and having huge periods of time where I can do nothing and other short periods of time where I can go crazy. So what enables people to grow a portfolio is two things. One is income, which is the main thing because you can save more of it and the banks like higher incomes, whether that's you on your own increasing yours or you and your partner together. The other thing that allows people to borrow money and move forward faster with one property a year or one every 5 years is either equity or cash, because you need to put down a deposit in Australia to buy property at this stage of the cycle. I remember in 2011 when I was buying, they were literally giving finance at 105%. What that means is they were giving you the full money for the property loan, plus they were giving you stamp duty and lender's mortgage insurance, all finance. So just remember, lending is tough, or has been tough for the last 2.5 years. It's actually getting a lot easier and has been a lot easier since November 2018. It will take 6 months for most people to understand that. It'll probably take a couple of years for it to flow back into the economy and the market, but that money's moving again, guys, so don't get too caught up. What is happening right now is the result of previous decisions. What comes in the future is a result of decisions now, and more money is starting to come around. Sentiment over a period of time will come around as well. So the thing to get you into your next property is, equity or cash savings as well as income. So you can theoretically have a conversation based on where you're at right now. Can I afford, based on my cash position, equity position, and income, to borrow again? And then if you just keep focusing on those two things, like buying below market value to create equity, renovating when you buy to make equity, buying at the right time so you get short-term growth in the right suburb, as well as continually increasing your income and making sure the properties you buy have amazing income as well, that'll make you look good for the banks in the future. Dave said, hey Ben, just currently waiting for a small build to be completed before considering next options. Just wondering what you consider a safe LVR for your entire portfolio when in the growth phase. Now, when I was in the growth phase originally, when I first got started and didn't understand risk, I had a very high LVR. It would have been probably 90 to 95% because I was very, very aggressively buying property in Sydney in 2011. because we'd just come out of a global financial crisis and it had been flat for almost 9 years before that. I felt it represented a good opportunity to buy. These days I'm super conservative, as everyone knows, and I keep my LVR as low as I possibly can. So I don't really want to disclose my personal situation, but I think a healthy LVR would be below 90% and a really healthy R would be well below 80%. But when you're in the acquisition phase, sometimes if it's a safe time to invest in the market where your buying looks good and your income is solid and you've got great income from the properties, you know, maybe that LVR can come up slightly. When you move into consolidation phase, which is where I'm in, you just really focus on getting that LVR as low as possible and smashing the debt. Stuart said, Robbo said, what is the current number of mortgages in distress in Australia and where can you get the data? There's this awesome thing called Google. You just Google number of distressed properties in Australia and it'll come up with where you find it. I was looking at it for you. According to Simon Priestley, one of Australia's leading analysts, mortgage or distressed mortgages in Australia are still sitting at very, 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 very low levels. That's a result of a number of things. One, good job security right now, low unemployment rates, almost full employment rates in many parts of Australia, rising incomes in many parts of Australia, the fact that a lot of people that own property in Australia bought it a while ago and have been paying principal and interest because that's what they do. So the number of distressed mortgages in Australia isn't high. It's possibly a little bit higher than it was last year just because some of those interest-only loans are flicking over to principal and interest, but it's well below what you consider like bad times, and that's one of the things Simon Priestley mentions and points out. He thought that current conditions have been self-inflicted by APRA rather than being the result of, you know, the reality of the Australian economy right now. But, you know, just always tread on the side of caution and it's a nice indicator to keep an eye on. Stuart said, hey Ben, like to know your thoughts on the impact on the market if when lending restrictions return to normal. Southeast Queensland gets another boost, obviously. How do New South Wales and Vic perform? Epic question, Stuart. Something I've been thinking about heaps. So this is the real estate cycle, right? We start the cycle here after the last GFC. They make money really, really, really cheap, like when I was borrowing at 105% in 2011. It's called pump priming the economy with cheap money. They pump all of that cheap money into the economy. We get to 2017, 2018. All of the share markets around the world and property markets have priced in that cheap money and therefore are expensive. Think Sydney and Melbourne. Then what happens is we go through this period of correction where property prices can go down a little bit like you've seen in Sydney and Melbourne. Share markets, stock markets can come backwards like we saw in December. And then we go through this period. Sometimes we go into a technical recession for a year or two before the government goes, shit, we've made it really difficult for people to get money. Money's not moving around the economy. Let's pump the crap out of it again. We go into the second half of the real estate cycle. Now from here to here is, and the bottom again is 18 years according to Phil and Fred. We get to the top and then not just, you know, property's priced in right now pretty accurately in Sydney and Melbourne. It's probably overpriced in, that's why it's declining based on that cheap money. But when we get to here, it's not just like, you know, people that have overexposed themselves, but it's banks, it's governments, it's money lenders all around the world, it's businesses, it's the stock market, it's the property market. And then all of a sudden people start defaulting on their loans because of all the overexposure they've got, and we get a land price-led recession. So in the middle here, it's more of like a stock market, business, mid-cycle slowdown thing, where at the top, it's really led by land prices in Europe and America that have a flow-on effect as all of those people default on their loans around the world. Now that's happened, according to Phil and Fred, like so many times over and over again that it's insane. What I love about Fred Harrison is he wrote a book, 2005, predicting the 2007 recession. he believes the next major recession, like top of market, will be 2026 when we go into the next bad GFC. Who knows? He also wrote a book before the 1990s recession in 1983, which was published then, predicting the 1990s recession to the month. So no one can predict the future, but these guys have studied so much history and they've found patterns in it. It's good for you to understand that stuff. What's going to happen in Australia is money's tight, but as of November, it started to loosen up, and that will start flowing through the economy again, particularly as we get to a surplus budget. Mining's kicking off again. Australian education to international students is kicking off in a big way. Tourism is kicking off, domestic and international. There's still a lot of infrastructure that's going to come in over the next 3 years. That's going to be the next kicker that will lead us back into mining and then housing again. There's a lot of stuff going on like that people need to be aware of. Another 350,000 people this year, another 350,000 Australians next year. That sucks up all of the oversupply in the capital cities around Australia. Money becomes a lot easier, and then what I believe that we see based on my analysis of CoreLogic and Australian Bureau of Statistics data in Sydney, Melbourne and Brisbane, as well as Perth, and then overlaying Phil and Fred stuff as the data geek I am, is Sydney and Melbourne do really well out of a GFC and then do not as well in the second half of the cycle, where other markets like your Perths and Brisbanes do very, very well in the second half, not as good in the first half. So that's at least how it's happened in the last 40 years, broken into 20-year chunks and then 5-year chunks. I'm pretty excited about this 5-year period we're going into for Brisbane. We're now in our 11th flat year, where if you look at CoreLogic's latest update, they've sort of said that, what did they say? That Brisbane is now cheaper when you factor in inflation than it was to buy in 2007. It's 2019 now, guys. That's pretty cheap. I'm going to stop swearing in my videos because some people have been hating on it. I'm sorry for that. So yeah, sure, great thing, man. Like, invest in the market that has the most potential for the stage of the cycle that you're in. You don't have to hold everything you buy forever. Like, you can just invest to ride a cycle. Like, I bought in 2011 in Sydney. You know, I got out of all of my New South Wales properties in 2016-17. I'm now buying in Brisbane and Sunshine Coast and potentially Gold Coast, and some of them I'll keep, but most of them I'll probably exit out of that market at the top and then reinvest it back into Sydney and Melbourne at the bottom of the next GFC. So, like, why would you knowingly hold a property for 10 years that's going to be flat for 10 years when you could reinvest that money and over that same 10-year period get a 20, 30, 50, 100% gain on the right asset? You've got to keep that idea moving. Like, parts of your portfolio are like your foundation is to get your properties and get your cash flow for life. But the reason I want you to have that cash flow is so that in a GFC, if you lose a job, you've still got an income that you can borrow more money to buy the really cheap distressed assets, because it's only once every 14, 15 years that you get a chance to buy stuff really cheap globally. And then, in the period between 2018 and 20, that's the only other period, in this 20-year cycle that you sort of get, like, to buy cheap assets. So, just remember, timing is everything. Dane said the Australian property market update. Dane said, sorry, Ben, the Australian property market, ? No such thing. I'll choose the Brizzy market. Do you think there'll be one day be an oversupply of granny flats in Brisbane, similar to a unit oversupply? I personally don't think so, because it's the only thing close to what affects my next move moving forward I can think of. Cheers, Dane. Brisbane's actually the only, according to Michael Matusik, the only unit market in Australia in any of the capital cities that isn't oversupplied. Now, in 16, 17, there was a lot of conversations with investors I was talking about the Brisbane inner city unit oversupply. But between 2017-18, what was a 5 to 7 year issue, every paper, every TV station in Australia talking about how Brisbane's going to collapse. all of those units have been absorbed because so many extra people have been moving up here from Sydney and Melbourne than was expected to. So there's no unit oversupply in Brisbane anymore, it's gone. In terms of granny flats, I know if you're listening to my stuff, it feels like the whole world's doing it. But the reality is maybe 700 granny flats were created in Brisbane last year in a city of, 2.3 million people. It's certainly not going to be oversupplied. But remember, man, there's not an Australian property market. There's capital cities that perform at different stages at different times. There's also no Brisbane. There's a series of suburbs. Now, some of the suburbs in Brisbane out west and south are already oversupplied and are shocking. Other suburbs in Brisbane have the lowest vacancy rates of anywhere in Australia, and they could add 50 or 100 granny flats in the next year and it wouldn't do anything to make a dent in that market. So suburb by suburb, you've got to start thinking that way as well as big picture market to market. Benny J said, "G'day Benno, in answer to your question, I'd probably like to know, the question I'd like to know is whether only your current lender can provide an appraisal when you're seeking to pull out equity. Appreciate the time you take with this stuff, mate." So, g'day Benny. I suppose with this sort of thing, if you want to remain with your current lender, then only their valuation is going to be the one that makes sense. But you can't control the valuation, but you can shape it. Now, the way that I shape it is, they don't know the marketplace as well as you potentially sometimes, and they're getting independent to people to value it. So what I suggest is getting on realestate.com sold section, getting all of the comparable sales that are, houses, or the sales for the houses that are directly comparable to what you own. And then if you've done any renovation on top of that, what we want to create is like a Word document that you can give to the valuer or give to the bank to consider, and they have to legally consider it. So what I want is all the comparable sales that are, what your property should be worth. I also want the date that you bought the property and how much the suburb has gone up in value over that time on top of that. And I also want, if you spent any money on cleaning the property up, itemized list of that, so that the valuer has like all of the information they need to go, okay, it was worth this, let's, put it in its best possible light without being over ambitious. Now, if your current lender is giving you a bad valuation, which a lot of the big lenders in Australia are really valuing things down, generally 20 to 50 grand below market value, what you can always do is effectively refinance the property, go to another lender, like change lenders, and then go to a lender that is going to give you a more positive valuation. Now, your mortgage broker will be able to point you in that direction. Obviously, again, asterisks, you shouldn't be buying if regardless of lender or what the broker's saying, if you're not in a financial position to do so. So this is only for people that are in a financial position where it's completely safe and stable to consider doing something again. Echoes has said, "Hey Ben, thanks for catching base. I'd like to know, do you think the market will slow down further in the next 1 to 2 years?" It's really nice actually after Benny's comment, because yes, I believe the Sydney and Melbourne markets will slow down. I also believe the Darwin market will slow down. And I have a feeling that sentiment's probably going to remain this way, which is quite negative right now in the media and in the community for the next year at least. Where other marketplaces, you've got to remember, are performing extremely well right now. So Hobart's expected to do okay according to Simon Priestley this year. HTW and CoreLogic are saying Brisbane's expected to do okay in the next 1 to 2 years and much better after that. All of the markets in Australia are at different stages of the cycle, but I expect Sydney and Melbourne to stay pretty subdued or even get a bit worse, like in terms of lowering prices, and then other markets beginning to pick up a little. Hessian said, "Hey Ben, how you doing? Yesterday I heard on the news about Chinese growth rates slowing down, but their credit levels rising significantly. Mostly not well managed, as one expert said. Another expert recently said on the news that the Australian market was going to crash by 50%, and that they thought prices this year would go down by 30% in Sydney and Melbourne. So, you just got to be careful. You know, it's all sensational. It's all to grab attention. These are the same news outlets that the moment before are talking about the person got stabbed or ran over or the child molester. Like, these people say, it makes me sick, like anything to just capture eyeballs. And generally the eyeballs they're capturing are the meat and potato people in the Australian marketplace. They're not capturing sophisticated investors' eyeballs. So take it with a grain of salt. What could lead to a recession in China, which would end up causing a recession in Australia? Considering how much Chinese investments have caused real estate prices to go up in Australia, how could investors guard against this? Really good question, man. The one thing that I do that I find a lot of people that I speak to don't is I just look at the bigger picture long term. Now, think about the worst case scenario. Australia goes into a bad recession and property prices drop. You know, it doesn't get much worse than a 10% drop in property prices at this stage of the cycle in 1 year in Sydney or Melbourne. Like, that's quite extreme what we've already gone through. And it's already starting to create confidence in the market because we're no longer like the bubble market around the world, and Sydney's no longer in the top 5 list of most expensive places. Like, everything's starting to settle down and change, and as time goes on, that will improve more. You know, the thing that could potentially, you know, get anyone out of anything is making sure they've got a really strong savings buffer, not worrying about their on-paper equity position. Like, who cares if you're planning on holding an asset for 15 years, if in the next 2 years it goes down by 10 or 20%, over 15 years it will still be where you expect it to be, which is the long-term average. So if you've got a long-term perspective, it can help. Obviously, the thing that everyone's watching is, you know, effectively the tariff agreement or tax agreement between China and America, but it looks like they're negotiating in a more meaningful way at the moment. At least that's what I'm reading into it and have been hearing from other experts that I follow on the economy. But the reality is, economies don't go up forever. Like, we're at a stage in the cycle where anybody who understands Fred and Phil stuff, like, knows this was coming for 3 years. So it's just about getting yourself educated and then working through that. Another thing that I do is I have really healthy savings buffers in place. I also have really good cash flow from my assets. I'm making sure that all of my living costs are as low as possible, that my income's as high as possible. I'm also making sure that, you know, I'll start to switch my loans personally, because now interest only and principal and interest rates are starting to normalize again, where a year ago principal and interest rates were a lot lower. So I'm starting to look at my cash flow position and potentially think about going interest only for my situation again. It's got nothing to do with yours or anyone else listening to this. It's not financial advice. I'm not a broker, but that's what I'm doing, so that rather than paying 40 grand or 50 grand a year off my properties, which is the principal component, I'm just going to, you know, save that money and put it into offset. So, you know, I'm also going to start looking at really hammering down my rates, paying off some more debt, you know, just all of those little things that you can do in this sort of time, as well as acquiring only properties with great cash flow that not only cover themselves but produce more income for me, so that I know I'll get the long-term capital gain, but while I'm waiting for that, I'm getting the great cash flow too. Jack said, "Hey Ben, love to know what your thoughts on the suburb Kalanga are of North Brisbane." Jack, I used to actually own a property there. I sold it in 2017. We've had one property there for the last 6 years and haven't seen much growth. Thinking of selling it and moving our cash into another investment. Jack, it's not Kalanga that's the problem. It's Brisbane that has been the problem for you for the last 6 years. Brisbane in the 6 years has done nothing. Like, literally 20% in 6 years, maybe. But that 20% that it has done has mainly been in the CBD, and it hasn't got 24 k's out of the city, which is where Kalanga is now. So it's important to acknowledge that your timing was off. It's not the product you bought. Potentially it could be, but it's more the timing of the cycle. Nothing's happened in Brisbane in 6 years, man. If you're moving that cash into something else, then you've got to be really thoughtful about what you're moving it into. If you did buy a house in Kalanga and you've got a nice big block of land there that you can build a granny flat on, then I think over the next 15 years, Kalanga is going to be okay. It's not going to be like Brisbane's top performer, but it is a meat and potato area where you can expect averages. And then if you can get your cash flow there is so good. If you can get a granny flat in, then happy days. But obviously, you know your situation better than me. Steph, hey Ben, how you going? I've been talking to Simon and Aaron, and they've been super helpful. Just waiting for my permanent residency before I pay your fee and start working with you guys. Steph, since you sent that email, you've actually paid us and you are working with us. We had a 6 strategy session 2 together literally this week, and can't wait to help you implement a great property with a granny flat, and then we'll do that again to set up your financial freedom and foundation. One thing I'm curious about is your thoughts on HMOs. That's what they call them in the UK, aka subletting room by room. In Australia, we call this renting by the room or boarding houses or rooming accommodation. We talked about this, Steph, but I'm personally not a massive fan at the moment in southeast Queensland where it is that I buy, just because the market isn't quite there yet for it. People don't quite understand it. But then I've heard people doing it in Sydney and Melbourne and getting good returns out of it. So it's not really my specialty. I don't want to speak out of school. It's not my personal investment strategy. You know, I like my simple strategies. I like to get my income up through doing other things like renovating houses and adding granny flats. You know, there's a lot more work involved in creating and then holding a legally approved boarding house, and just all the tenant issues. Like, I'm more of a passive investor that just wants the recurring income stream for life. Now, I've done the numbers on boarding houses in Brisbane a lot of times in the last 4 years. Some of Australia's leading people that are in that space constantly keeps coming to us and saying, can we implement that as a strategy for us, for their clients? And I just can't make the numbers work better for the risk and for the extra time involved and all the extra costs. Much better than a granny flat. It might be 1% better per annum. It's just not worth it to me right now. I just said, hey Ben, when will the property market rebound? Good question. According to Simon Priestley, we should expect to be starting to see double-digit price growth in Brisbane and maybe Perth in the next 2 years from today. It's pretty exciting, but people have been saying that for 6 years, so who knows what's going to happen. Sydney and Melbourne, they're going to take, from my perspective, ages to recover. In terms of the time for me to be buying them again, it won't be till the next GFC, because historically this next phase we're going into hasn't been very nice for Sydney and Melbourne in terms of the gains that I'm looking for, because I don't want just your average gain. I don't want to buy Sydney and Melbourne now and then have to wait 5 years to start getting returns, only to go back into a GFC after that and then be right back or below where I'm starting from. So, you know, obviously if you're buying to live in, it's a different story, but if you're buying to invest, Southeast Queensland looks good. Adelaide maybe, it's not my thing. Perth maybe, Canberra maybe, you know what I mean? Some of the major regional markets that aren't attached to Sydney and Melbourne, so maybe your Sunny Coast, your Gold Coast, your North Brisbane's. Timothy said, hey Ben, like to know which seaside suburbs in the Sunshine Coast with nice beach is worth looking into further. Great question, Timothy. The Sunshine Coast is actually a huge area, like it's a massive area. When I'm looking at the Sunny Coast, I only look at the bit connected on the south side of the coast to Brisbane. That's where all of the infrastructure is going in. That's where, you know, the CBD is going to be in Maroochydore. So that's even too far north for me, but that's good infrastructure for the coast. When I'm looking, I'm literally only buying from a place called Point Cartwright through to Shelley Beach. So everything along the beach there. And when I'm buying it, I'm only buying on the beach side of the main road that runs through called Nicholson Way. Now, it's expensive to buy there, but that is where everyone wants to live. They're the suburbs they're going to get the most benefit from the new hospital long term. The suburbs are going to get the most benefit from all of the infrastructure. There's a light rail going in there that's still connected to Maroochydore CBD, that's still right next to Mooloolaba for lifestyle that's next to Caloundra for lifestyle. That's where a lot of the jobs are being created. That's where people can easily drive down to Brisbane for work. So they're the areas that I like, Point Cartwright through to Shelley Beach, and I live in those suburbs, and that's where I like to help people buy to. Andrew has said, hey Ben, when are the experts on property going to actually advise people that there are great yielding residential properties in strong regional markets in Australia with affordable cash flow properties, not capital cities and negatively geared regional areas or mining areas? They are clearly not cutting it, even long-term holds. There is life outside the majors. Good question or comment, Andrew. The reason I talk about major capital cities and major metro markets is you can get great cash flow. Like I'm getting 6-7% returns on my properties in Brisbane right now on the Sunshine Coast. Like that's amazing. Just rental returns. Not from your standard house, but from a house in a granny flat. The reason I talk about metro and most experts do too is because most people in their lifetime, most Australians might buy one property. A few Australians will buy two, and almost no one buys three or more. If you're only making, one or two purchases in your lifetime, then you're costing yourself potentially hundreds of thousands of dollars, if not millions of dollars, chasing that short-term cash flow in regional markets for the long-term growth that you'll receive in the capital cities and the major regionals. Now, the thing about this isn't my opinion. This is just what I've learned from CoreLogic. CoreLogic did an analysis of the Australian property market over the last 25 years where they looked at the 7 biggest metro versus 7 biggest regional markets. The metro markets grew in value over 25 years by an extra 96%, almost 4% per annum over the regional markets. Now, if you're the average Australian that is happy to go to work and will sell these properties in the future to fund their retirement, if you're chasing the extra $100 a week in cash flow, you're literally costing yourself hundreds of thousands, if not millions of dollars over a 50-year period on those couple of properties. So the capital growth rates in Sydney, Melbourne and Brisbane have been stronger. 75% of Australia's population and job growth is going into those areas. If you can affordably pick up those properties at the right time in the cycle cheap, ride the long-term growth wave in those markets, and then get great cash flow because you bought at the right time cheaper and you added the right type of product like house and granny flat, you can be in such a good position, like get amazing cash flow and be in the capital cities and not miss out on all that growth. Regional markets also get smashed in GFCs because there's not the population, infrastructure or jobs to support it. So that's just my 2 cents, man. Like everyone's got an opinion. I agree that there's great areas outside of the capitals, but as someone that's not going to buy that many properties in my lifetime, I'm just not rolling the dice and trying to beat the house, because after looking at 200 years worth of data in Australia, the house always wins, and I'm just going to play, the long game rather than the short-term cash flow game. Like I could not care less if I got an extra $50 to $100 a week passive income from a regional property, if that's going to cost me $200,000 or $300,000 over the next 15 years in growth, personally. But other people are looking for cash flow, maybe going and buying a $200,000 home and getting $400 a week rent, like some of the first properties I bought, could really help people set up their futures faster. Peter said, hey Ben, I've heard the banks may be changing some of the strict restrictions on lending. Now, he sent this in January. Peter, the banks actually changed this in November last year, so they've already made all of those changes now. And they'll stop forcing us to pay principal and interest. That's one of the major changes that they've made. So what they did is APRA came in and put a speed bump in saying you're now no longer allowed to take on investors or more than 30% of your balance sheet being investors, and that's been like that for 2 years, 2.5 years almost, because a lot of this stuff was happening behind the scenes before it became public to the mainstream person or media. And on top of that, they wanted a huge percentage of all loans written to be principal and interest. In fact, almost every loan that's been written in the last few years has been like that. So they're no longer wanting as many principal and interest loans, and they no longer care about how many investors that they take again. So not only that, but money is beginning to flow again. Now, this is going to take a long time for people to, for it to come all the way through the Australian economy again, because, most people are always 2 years behind what's actually going on inside an industry. But, it's good news for me and you to know this stuff now, because it's a game changer. Like, knowing what's coming in 2 years, which is good conditions, means that you can use the next 2 years to strategically set yourself up while other people aren't. Austin said, I'd be interested to get your perspective on the Brisbane market, particularly Q4 of 2019 and throughout 2020. In the midst of the 2020 crash predictions, is it wise to enter into the market? Now, 2020 crash predictions, the mid-cycle slowdown dates are sort of 2018 to 2020. 2021 is kind of like the end of it, according to Phil and Fred and their historical modelling. And it starts, off to the second half of the real estate cycle from then. I like to buy when other people aren't buying. Who knows what's going to happen over the next few years? Who knows how bad sentiment's going to get? Who knows if America's going to go into a recession, or, China's going to have an effect, or which political party's in place. Like, if I buy a property today and it drops in value by 10% in Brisbane over the next 2 years, over the next 15 years, or even 7 years, I'm really confident that I'm going to make that back plus a bunch more, which is why I'm still continuing to personally invest now. I bought a property literally last Friday. So for me, it's business as usual with a long-term strategy. I did a lot of culling of properties. Like, at the top of the market, I sold 4 properties in the last 18 months with the sole intention of getting out at the top and then using this period, which I now am, to reinvest, because I don't want to be buying when everyone else is buying. I want to be buying now when no one is. Lisa said, what are your thoughts on the Queensland unit market? Got a one better in Hamilton, but are concerned about oversupply. There's definitely still an oversupply issue in Hamilton because there's just so many new projects still yet to complete or being completed. I honestly don't think a one-bedroom unit in Hamilton is the best long-term investment for the amount of money you'd have in it, but I'm not a financial advisor or accountant, and I don't know your position at all. Certainly not advice. For me, I don't buy units. In terms of the oversupply issue in broader Brisbane, Michael Matusik has now said that Brisbane is undersupplied citywide by units, but a particular suburb like Hamilton might still be an oversupply. So, it's your decision. Effectively, I look at the potential for growth in something like that. I look at the potential risk as well. A lot of those units in Hamilton were sold to investors like yourself for far more than they were actually worth, which is why the Brisbane unit market in the last 3 years has come backwards by 20%. You've got to remember that, you've got to think about what happens in a GFC when 70% of the people in your building can't afford to hold it anymore and they need to sell out. What happens to valuations? How long does it take to recover after that? Is a one-bedroom unit what is the right product to hold, knowing that houses in the last 20 years have outperformed units in Australia by 86%? It's a huge amount of money you're leaving on the table by not having that in a high-quality house in the right suburb, particularly with the growth that's going to come in houses over units in Brisbane, because everyone's still cautious of units in Brisbane over the next 7 years. So your call, Lisa. I've sold all of my units. Actually, I only ever owned one unit, but I'm also got rid of all the properties that have small pieces of land, because I know land size, houses, the right suburb, the right time is my foundation, and I just apply what I know now. I don't learn all of these things and then not make a decision to change, which is why I sold 4 properties that don't align with my current strategy and out at the top of the market in the last year and a half, because why would I knowingly get myself a 3% return when I can go find a 5 or 6% return on my money? That is a game changer. That's the difference between ending up comfortable and wealthy in the future. Hey Mish, hey bro, how you doing, man? Good to see ya. Thanks for the email. Loving the new podcast. That's the Pumped On Property Show, guys, for anyone who hasn't checked it out. If you had to buy a property in Brisbane in early 2020 for sub 500, where would you buy it? It's a really hard question, man. Like, you're an ex-client of ours and you know that every 3 months we're constantly reviewing the market and updating the suburbs. Right now it's difficult to tell, but I still will like Brisbane Northside at that time. Reason being, Michael Matusik in the next 5 years has said that 36% of the jobs on the north side of Brisbane will be in that very high income bracket, where only 6% on the south side will be in the high income bracket and 8% on the west side. So I'm a north side guy, whatever that means. Because I just chase the high incomes, the low vacancy rates, the infrastructure spending, the population growth, and where the mums and dads are living, not where all the investors from the southern markets are being sold shit stuff. So it's going to be Northside, bro. Just reach out to me at that time and I'll let you know what we're up to and point you in the right direction. Chris has said, yes, I'm onto the final page. Man, these questions are huge. I thought this would be like a 20-minute video. It's like 20 minutes into it now. If you're still with me, thank you. I hope you're getting some value out of all this. I'm about to take off for a couple of weeks. Actually, I'm heading down the east coast of Australia with the family, which would be sick. I haven't done that drive in ages. Staying at Port Macquarie and Yamba on the way down, and then doing a live event in Sydney and Melbourne, which would be awesome. First live event. I think we've got like 130 people confirmed at each venue already, which is nuts. And then how many of them show up, I don't know. And then coming back, we haven't even planned it yet, but I know we're stopping in at the Central Coast, and then we'll see what we want to do. I got a hot tip about Southwest Arms. I heard that's beautiful as well, Southwest Rocks. Sorry, Chris. Hi, I like a house for guide of $699 in Robertson. The agent is pushing $7 to $720. I said I'd make him an offer, but held off considering the market would slow down. Good decision, because it is slowing down, and you could probably buy in Robson 10% cheaper by the end of this year than you can now. Just called after a week later and text asking if I was still interested. What that means is the agent has absolutely no other leads or no other interest in the property, and you have the power. What's the best way to get the price you want? I just did a huge video on this, which will come out around my actual negotiating tips. It's called How to Negotiate Like a Pro. It'll be up on YouTube soon. I tell you exactly what to do, but because it's soft market, you effectively do 3 things. You've already inspected the property. I'm assuming you've already gave away your whole position, which is going to take your ability to negotiate properly, but you go in with a really shit offer. I would have gone in at $640,000 personally, with really shocking terms like 90 days settlement, 30 days building and pest, 30 days finance. Then you come in with a better offer, much closer to what you're prepared to pay. I think $699 is over market value personally, knowing that the market's going to drop by $60K this year there. Potentially, I don't know. But it probably will. Or it could, or someone in the suburb will sell it something to you for 10% cheaper later in the year. You believe 685 would be a good buy. I reckon 640 would be a good buy pricing in the future that we know is coming down there. So you go in with your 640 offer with bad terms. You go in with another offer. I would have just gone in at like 650 with much better terms, like 30-day finance, 30-day settlement, 21-day finance if you can do that, 7-day building and pest. Then they negotiate again, and then you go in best and final one offer. Now, the thing is, you might lose this property doing that because the market hasn't already dropped by another 10%. But if you're patient, one, there's going to be far less people buying in that area later in the year because people get spooked more and more. Second thing is there's going to be less competition and you can probably buy better. So if you bought it at 685, good on you. It's cool. It's a long-term investment. You're going to do, I don't know Robinson at all, so I don't know how you're going to do, but I'm sure, based on the history of Australian property prices 20 years from today, they'll look better than they do now. But negotiating is an art. Like, check out that video. It's so clear what you need to do, and I've saved my clients literally millions of dollars from using that exact strategy that I talk about in that video, how to negotiate a property like a pro. Nicholas, hey Ben, I'm in hardcore debt payment phase at the moment, man. Currently paid off 30k in the last 12 months. Legend. I suspect I need another 18 months to have a deposit saved up. Am I going to miss the boat? No. Because you're playing a 15 to 30 year game, and what happens in 1 year means nothing to you in 30 years time. So anyone that feels like they're missing the boat by paying off debt, or the banks are saying right now that they can't borrow money, you're not. Even if you are, you're not. Because people that bought at the top of 1988, before prices dropped by 25% in the next year and a half in Sydney, have still made 300% since then. So regardless of if you're buying the top or the bottom, if your long-term intention is to hold for 15 to 30 years, you'll generally be okay. Obviously, I want you to learn how to time the market and buy at the right time, but don't stress yourself out, man. Like, you're not going to miss anything. You might miss 10 or 15% growth in the right suburbs in southeast Queensland, but there'll be another suburb that you haven't missed that you can get into at that time. So never, ever, ever feel like you're missing out on anything. Life is just a big adventure, and I was watching this doco the other day, and they interviewed 4 professional athletes or 5 professional athletes, and they said, what would you, they're all 50 now, 45, 50, they said, what would you say to your 20-year-old self? They all said, you'll have more time than you think you do, so enjoy it, slow down, and remember the bigger picture. Look after yourself better. Irene said, hey Ben, what month is a good time to purchase property in Sydney this year? No month. Sorry Irene, don't buy property in Sydney this year if you can, because it'll be cheaper next year than it is right now. But if you are going to buy something this year, the best month of the year to buy in is either December or January, because that is when everyone's in holiday mode and no one has come back into the new year yet. / the later you wait to buy in Sydney this year, the better the investment decision you'll make, because the cheaper the property is going to be to buy. Daniel has said, hey Ben, currently rent in Sydney and own in Newcastle. Previous PPR, principal place of residence, has really good equity. I also own a property in Brisbane, which I'm currently being developed into a townhouse and will be sold. I'm expecting to make a 100k profit. Once the townhouse is complete and sold off, I'll be looking to sell my home in Newcastle. CoreLogic expect a nice amount of growth in the area Hunter in 2019. So I'm hoping to have 300k equity when you sell by the end of the year. Well done, man. That's awesome. My current dilemma for when I sell is, do I buy in Sydney or give up that dream and rent? I'm worried that after 2020, I'll never be able to buy again in Sydney. I reckon in the next recession or depression, you'll be able to buy Sydney for 60% of what you can buy it for now. Not realestate.com, but what the solicitors are selling, what the public trustees selling, what the banks are selling at auction, mortgagee in possession of people that at that time are overexposed and can't afford it. But at that time, no one else will have money to be able to buy it. So you'll be competing with no one, and everyone will be so scared. Never ever feel like there won't be a cheaper time in the future to buy what you want. There always will be, if you can time it and if you're patient enough to wait. I plan on buying like a sick house at Cronulla overlooking the water. It's in the next recession or depression, or a unit down there as a holiday Airbnb thing, or just temporary accommodation for me. And I plan on buying it like 50 cents in today's dollar. Even if it drops 10% this year, 50% of that dollar, because someone is going to be forced to sell, and me, you, and only a few other people are going to have the money to buy it from them at that time. So take a chill pill, man. You'll be able to get a great property down there. If I do buy in Sydney, I'll be looking to use the 300k in cash to borrow 780, which would give me a small amount of equity based on an 80% LVR. You'll probably only borrow again if my PPR was interest only. Now, the dilemma that you have, and then I'll finish the questions, is, do I buy my PPR or do I create financial freedom and invest? Because you're not only chewing up all your money and all your servicing in one property that probably isn't going to grow in value in the next 5 years, you are also stopping yourself investing in other assets that produce income so that you don't have to go to work anymore. So let's say it takes you 15 years to pay off that property. That's 15 years longer that you have to work, and then you need another 15 years on top of that to go pay off a couple of other houses with recurring passive income for life. So effectively, the one decision to buy an expensive principal place residence today, rather than waiting to do it when other people are paying for it for you, i.e. the passive income from your properties, and buying it at the wrong time, especially without getting growth in the short term, it's just deadly, man. Like, it's 15 years of your life you're choosing to have for a property that you can rent a $1.5 to $2 million property in Sydney right now for $600 to $700 a week. It would cost you $3,000 a week principal and interest to own the property. So if I was living in Sydney now, regardless if I had just had the best income in the world and I was making $5 million a year and had $10 million in the bank, I wouldn't be buying anything. I'd be renting it from someone else who's losing $2,000 a week to rent it to me. So yeah, like, you know, not being brutal, man, but that's my honest opinion. Like, be patient, wait, see where the market's at in 12 months down there. It might represent the bottom of this current cycle, but you've got to understand the history, and Sydney doesn't look fantastic until the next GFC. Questions are, with 300k deposit and combined wage of $220 a year, well done, man, you guys are crushing it. My soon-to-be wife with zero dependents, how many projects could you see me taking on at once? I could see you taking on one principal place of residence in Sydney, and then effectively, you know, $200,000 goes to the Sydney property, keep $100,000 for another investment. So 2 projects that way. If you weren't doing the principal place of residence in Sydney, I could see you literally buying 4 houses and putting 4 granny flats on them in the next 2 years, which would in 15 years time give you a $200,000 a year passive income for life if you can pay them off. You know, maybe you don't want $200,000 a year of passive income for life. Maybe you just want 100, so you just buy 2 houses, build 2 granny flats, put the rest of the money in the offset account, and you know, maybe go buy one more property that's more of like a project, and you know, use those chunks of cash to pay off the debt faster and get financially free sooner. Like, you're in such an amazing position, bro. You can do whatever you want. Talked to another client yesterday, Trent. Him and his wife Danny are clients of mine. They're just killing it. They're in such a good position. But instead of buying the principal place of residence, they just built a home which they've made $200,000 equity on. They've also bought another property which they're building a granny flat on with us, and then they're going to buy another home and build another granny flat. So the difference between them and you is those 3 purchases give them $2,500 a week of income from the rent, and they've got flexibility, and they can leave the high-paying jobs that they have and move back over here from WA and chill with their kids. You know, having a really high personal level of household debt that's non-tax deductible that you're not getting an income from just crushes your ability in the current market to move forward and puts you at risk in the future as well. So I don't know, like, see where the market's at. If it's a 30-year buy and hold in Sydney and you can buy it for, you know, 25% cheaper than you could have in 2017 this year or next year, consider it. But I invested first and then bought for myself second. I bought 12 properties, 11 of which were before I bought my actual dream home. To put it into perspective, man, like, I delayed all of my gratification till I was in a great position to do it, because I didn't want to get in that great position to do it and that affect my ability to keep going with other stuff. 2, what kind of growth do you guys aim for with these sorts of properties? As much as possible. As much as possible, man. Like, I aim for the absolute best cash flow I possibly can. I aim to buy at the absolute best possible time, depending on where I'm buying, that I can, as close to the bottom as I can. I aim to get as much short term being 7 years growth as I possibly can. And I aim to buy a property that I can add value to and make as much short-term equity through renovation, subdivision, adding a bedroom or bathroom as I can. So I'm not your average investor that's happy to just buy and hold and hope. I'm like in every way manufacturing value or cash flow or timing into my deals so that I'm just going, instead of getting the standard 4% a year return with a 3% rent return, I'm getting a 5 to 6% or even 10% return growth-wise through my assets, through the activity I'm doing on them per year and the timing that I'm using, and then I'm getting 6, 7, 8% in some instances rental returns. So that's the sort of thing that changes the game long term. And an example of this is if you were to get a 2% better return on $1 million, so get a 6% return instead of a 4% return on your $1 million over the next 15 years, the difference just by getting 6% versus 4 is, I'm not joking, man, almost $600,000 of extra growth. So imagine you could get 4 or 6 or 8% better return per year on that $1 million. It changes your life. It changes everything. And if you want to understand that, watch Warren Buffett's recent HBO documentary. He talks about the power of this compound growth. Robert, hey mate, how are you? Good to catch up. Hope you guys are doing well. Do you think the demand for inner city Brisbane housing will exceed supply in the next 5 to 10 years? Hell yeah. Hell yeah. Maybe not inner city units, but 100% demand is going to outstrip supply. Like the vacancy rates in parts of Brisbane are so low right now. There's so many people moving into southeast Queensland. It's not funny. And we haven't even seen the big move yet from Sydney and Melbourne. After the glut of high-rise builds that have come on stream recently, the actual glut of high-rises was 3 years ago. That was the real issue 2 years ago. Like I said, according to Michael Matusik and ABS's population growth, Australian Bureau of Statistics, population growth recently, all of those inner city units have been picked up. There obviously is a lot of sites that didn't start that will come on now that they can, or when money starts moving again, they will. And there are some suburbs that are oversupplied, like Chermside and Hamilton and stuff, that you want to avoid. But you're not going to be buying units. And what I've noticed is that the unit market didn't have a huge effect on the housing market. It did have an effect on itself though. So units have dropped by about 20% in the last 3 years in Brisbane. But apparently demand is meeting supply now because of all those people moving up. Hey Ben, I'm wanting to extend my property portfolio. I'm young. I own 7 new homes which are all leased out. Holy shit, man. Well done. Do you know of any banks which are more lenient than others? The banks are regarding me now as a professional investor. I work as a teacher and earn $83,000 per year. That's huge, man, that you've bought 7 properties and have rental income of just over 80 grand per year. Having difficulty getting finance. Man, you're not going to be able to borrow money for a long time. You're done. So that's just being honest, and I'm sorry about that, Ben, but the reality is, with the current conditions as they are, and the fact that we've moved, even with the current conditions being easier and money beginning to flow again now, the way that they're looking at loans at the moment, you're not going to be able to borrow money again. In fact, in today's environment, you could have bought 2 properties and you own 7. So just be grateful for what you got. Review what you've got. Decide, I suppose, what your plan is on those properties, what you've got. Focus on increasing the cash flow. Focus on reducing the debt. You're in an amazing position which you're going to be financially free on. No one in Australia is going to touch you, man, private or public lenders. What I would be doing if I was in your position is seriously reviewing your position based on a couple of properties being vacant at a point in time and interest rates increasing by 2 or 3% and all of your loans being principal and interest, because my concern for you isn't so much can you borrow again, it's are you overexposed at the wrong time of the market. So really systematically review those properties and make sure you're in a safe position, mate. Rainer said, Rainer's having a laugh with me. He said, ha ha ha, Ben. That's easy. Which property should I buy that is guaranteed to double every year in value and provide a 20% yield and have perfect tenants that never leave? Love you, mate. I know you won't be listening to this because you're not going to be listening an hour, 30 minutes into it, but you're a legend. I responded to this one via email, which was pretty much just the finger sticking up, saying go talk to the property spookers who teach you how to get rich quick. I know that almost everyone in Australia could find that option for you, except for us here at Pumped On Property because we're realistic. Peter, my last question. Thanks, mate. Stoked. Actually, I've already answered this question. Hey, Ben, I heard the banks may be changing some of the strict lending they already have. So, I suppose the, combination of questions that we've been answered, like we've kind of addressed where the property market is and where it's going, which I know is important to you right now, which answers that question, is now a good time to consider buying or not? I believe it's the best time in the last decade, personally. I've been waiting for this time and I'm excited that it's here and that we've been going through that time for a year. We've also addressed the Labor thing and the government change thing. We've talked about Sydney and Melbourne and my thoughts on that, which is don't touch them this year or for a while if you can help it. We've talked about having a longer term approach. We've talked about China. We've talked about recessions. We've talked about money lending. I think there are a lot of the big things going on right now. We've talked about the media. We've talked about where I believe the next stage of growth is going to come. We've talked about where the wider cycle's at the moment. Like, these are the big questions on my mind. And obviously, from 200 questions being asked literally in the last month, these are the big consistent questions that kept coming up for everyone. So, sorry I couldn't on video answer everyone's questions, but I answered every single person's email. Personally, I wish you all the best. I'm so excited for the next couple of years personally. I don't expect much. I never expect anything from my properties in the short term. So I do expect a lot from them over the next 15 to 20 years. So, and I'm excited for you, whether you're just getting started or you're right down the line. It's not a good time to buy Sydney, Melbourne or Darwin. It might be an interesting time if you're in a safe position to really start considering Brisbane, Sunshine Coast, maybe if you like regional, and Perth potentially. I think Hobart's done its dash. I'm not a fan of Canberra, like I said, and Adelaide, like they're just not markets that I look at personally. So I wish you all the best. Please subscribe to the YouTube channel if you haven't already done it. Please take a look and listen to our podcast, The Pumped On Property Show, on iTunes and Spotify. If you're not already following us on Facebook and you don't want to listen to me for 140 minutes every time I do a video like this, I do like 1 to 2 minute versions of videos every day on Facebook and Instagram. Follow us and like us there. If you're sitting here going, holy hell, my brain is exploding, but in all of this, you've got some confidence around the next few years and you are seriously thinking of buying a property and setting yourself up, and you like the low risk, long-term approach to investing I have, jump over to my website, www.pumpedonproperty.com, book in a free strategy session with me, and let's talk. Let's find out where you are, where you want to go. Let me educate you a bit on my thoughts on the market. Take them with a grain of salt. Go off and do something on your own, or become one of the really small number of clients that we actually decide to take on each month, because we used to take on 15 every month. We still get so much inquiry, it's insane, but we just handpick really cool people that get it, that want the right outcome, that believe the same things that we believe, and that want to do better than average. So if that's you, let's talk. It's a complimentary session. There's no obligation. There's no hard selling stuff. I hate salespeople and selling stuff, but I'll try and add value and I'll be genuine like I am. So subscribe. Hope you've enjoyed it. Give us a thumbs up. If you've got other questions, chuck them in the comments section below, and what I might do is another video in another couple of months' time with all your new questions. Everyone's got a different opinion, guys. This is just mine. It's not right or wrong. It's got nothing to do with your situation, and it's just my thoughts. Like, don't hate the game. Hate the player, sorry. Don't hate the player is what I'm trying to say. Like, I'm just trying to do my best and set my family up for financial freedom. And I don't want to work for the next 50 years. So, you know, what am I going to do? Business, yes, I'm doing it. Property, yes, I'm doing it. Shares, yes, I'm doing it. I'm doing the stuff that everyone else that's ever set themselves up for the future and brought, you know, things forward in terms of their timelines is doing. Do I have a preference for any of them? No. Do I try and educate myself on all of them as much as possible and make really low risk, sensible decisions? Yes. So there's a lot of other people that are smarter out there with me in terms of economic stuff and theory and cycles and trends, and most of them are broke. I don't know what they're doing. I don't want to be the dude that's strung out or over leveraged at the wrong time of the cycle. I'm super conservative, but I also know that I'm not going to work a job that I hate for the next 30 or 40 years and just crush my soul. I'm going to continue to move on, regardless of what 60 Minutes is saying or the Today Show in the morning. So cheers, guys. Good luck this year. Have a good one. Wish you all the best. See you soon.